Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Quick Guide to Break-Even Analysis. Simplify your finances. Break-even analysis. How to find your profit point and make smarter business decisions. Every business owner faces the same question: at what point will I start making money? That's where break-even analysis comes in. It's a key tool that helps you figure out how much you need to sell to cover your costs and avoid losses. Understanding this isn't just helpful, it's essential, whether you're running a startup or managing an established business. With the right approach, you can make smarter decisions and set your business up for success. Understanding break-even analysis. Break-even analysis is a straightforward yet powerful financial tool that gives you clarity about your business. By understanding where your costs and revenues meet, you can make better decisions and reduce financial uncertainty. This section will break it down into key concepts. What is break-even point? The break-even point, BEP, is where your total revenue equals your total costs. At this point, you're not making a profit, but you're also not losing money. It's the line in the sand that separates profitability from loss. Every business has fixed costs, like rent and salaries, and variable costs, like production materials. Together, these make up your total costs. When your revenue from sales covers these costs, you hit the break-even point. For example, if your bakery needs to sell 1,000 muffins a month to cover costs, that's your BEP. Sell fewer, and you're losing money. Sell more, and you step into profit. Understanding BEP is essential for businesses of all sizes. Whether you're a solo entrepreneur or operating a multi-million-dollar company, knowing this number keeps you grounded in reality. It's not just a number, it's your financial checkpoint. Importance of break-even analysis. Why does break-even analysis matter so much? Because it helps you see the bigger picture while managing everyday decisions. At its core, it's about control and foresight. Here's how break-even analysis benefits your business. Financial planning. It gives you a clear picture of how much you need to sell to avoid losses. No guessing, just facts. Risk management. Wondering if a new product is worth launching? B can show you how risky that decision is. Pricing decisions. Unsure if your pricing is right? B tells you if your price will cover your costs. Cost control. It highlights whether your fixed or variable costs are too high and where to cut back. Think of it like a GPS for your business finances, showing you where you currently are and where you need to go. It's especially useful for startups, where every dollar counts, but it's equally valuable for established companies looking to scale. Would you open a store without knowing how much you need to sell to stay afloat? Of course not. That's exactly why B is foundational. It provides the clarity needed to move forward with confidence and to avoid unnecessary risks. Key components of break-even analysis. To effectively conduct a break-even analysis, you need to understand the components that impact your costs and revenue. Each element plays a role in calculating how much you need to sell to break even. Let's break them down. Fixed costs. Detail what fixed costs are and provide examples. Fixed costs are expenses that remain constant regardless of how much you sell or produce. These costs don't fluctuate with your business activity. They're the bills you have to pay no matter what. Think of them as the baseline costs required to keep your business running. Examples of fixed costs include rent or lease payments for office or retail space, salaries for full-time employees, excluding hourly staff, insurance premiums for your business or equipment, utilities like internet or phone bills if they don't vary with production, loan repayments or equipment depreciation. These costs create a foundation for your break-even analysis. No matter how many units you sell, this baseline expense always exists. That's why it's critical to control and monitor fixed costs. They can significantly impact your break-even point. Variable costs. Explain what variable costs are and how they differ from fixed costs. Unlike fixed costs, variable costs are directly tied to your sales or production volume. When you produce or sell more, these costs go up. When you produce or sell less, they go down. They follow your business activity closely. Here are some common examples of variable costs: raw materials or supplies needed to produce your product, packaging costs, like boxes or labels, shipping fees to deliver products to customers, wages for hourly workers or freelancers who get paid based on output, sales commissions if you pay your team per sale. Variable costs differ from fixed costs because they rise or fall depending on how busy your business is. For example, if you're running a bakery, your spending on flour, sugar, and eggs increases with every additional cake baked and sold. Understanding this distinction is crucial to calculating your break-even point accurately. Sales price per unit. Discuss the role of sales price in determining the break-even point. The sales price per unit is the amount you charge for each product or service. It's a key piece of the puzzle in break-even analysis because it determines how much revenue you generate per sale. Why does this matter? Because every unit sold contributes to covering your fixed and variable costs. The higher your sales price, within reason, the fewer units you need to sell to break even. On the flip side, if your price is set too low, you'll need to sell significantly more to cover costs. When setting your sales price, consider market demand. What are customers willing to pay? Competitor pricing. How do similar products or services compare? Cost structure. Does your price cover both fixed and variable costs? For example, if you sell a product for $50 and your total costs per unit are $40, you're making a $10 contribution toward profitable operations. A miscalculation in pricing can make it nearly impossible to reach your break-even point, so take time to get this number right. Contribution margin. Define contribution margin and explain its significance in B. The contribution margin is what's left from the sales price after subtracting your variable costs. It's the portion of each sale that contributes to covering your fixed costs, and eventually, to generating profit. Think of it as the fuel for reaching profitability. Here's the formula. Contribution margin equals sales price per unit variable cost per unit. For example, if you sell a product for $50 and your variable costs are $30, the contribution margin is $20. This means every unit you sell chips $20 toward covering your fixed costs. Once fixed costs are covered, that $20 per unit turns into profit. Why is contribution margin important? Because it's the foundation for calculating your break-even point. The higher your contribution margin, the fewer units you need to sell to break even. On the other hand, a low contribution margin means you'll need to sell a lot more to cover your costs. In practice, a business with low fixed costs but a high contribution margin can break even quickly. A business with high fixed costs and a low contribution margin faces a tougher climb. By analyzing your contribution margin, you gain insight into whether your business model is sustainable or if adjustments are necessary. Calculating break-even point. Calculating your break-even point, BEP, is a critical step in understanding the financial health of your business. It's the one number that tells you how much you need to sell to cover all your costs. Whether you want to launch a new product or assess your current pricing, knowing how to calculate BEP gives you the clarity to make confident decisions. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.